So we're going to wait kind of like 1 more minute, 2 more minutes, and then we'll kind of get going here. This is a fairly short topic, I think. So we should have some time for questions if people have it. But when we start talking about sponsors, it's a relatively important topic for you to understand when you start thinking about what size of property you're going to buy and what you may need to get the deal closed. So all right, we're going to go ahead and get started. I want to respect people who got here on time and signed in and appreciate it. So the first thing we want to talk about is what is a sponsor. So basically, when you are buying a larger or even a medium-sized commercial property, multifamily property, that you're dealing with commercial lenders, and they are really concerned that they are going to their mortgage or their loan is going to be safe, because a commercial loan that goes bad causes a lot more damage to how much they can loan before the regulators say they are no more. So if you look at the couple of bank failings that we've had, the Silicon Valley Bank, et cetera, basically what happened is it was determined that, so whether a bank continues to exist or not is dependent on their ratio of deposits versus loans, good loans, or the bad debt. The more bad debt they have, the more deposits they have to have. So the feds basically say, come up with a number. And if you drop below that number in your ratio of deposits to debt, good debt, then it's called a red line and you are no more. And that's basically what happened to Wachovia and several other banks in 2000, 2007, 2008. And it's what's happened to Silicon Valley. So Wachovia basically had too much bad debt. Silicon Valley had a lot of investors pulling their money out. So both resulted in that ratio becoming below the red line. So when you start talking about $1 million, $10 million loans, the banks get very careful to make sure that that loan is going to be a good loan. And so what they want, if you are a relatively new investor, is they want somebody to sponsor that loan. And what that basically means is that if it's a partner, that somebody has a balance sheet, has enough have enough income, has enough assets, that their loan is safe. So in simplistic forms, it's basically somebody co-signing for your loan and sort of saying that if you can't make the payments, that they will step in. So once you start getting much over $1 million, $2 million of a loan, then banks are going to start looking for you to have a sponsor, right? So what the banks are going to look at, or what the lenders are going to look at to see if there's a sponsor is needed, if they're going to require it, is the financial statement of you and any general partners you may have in that purchase with you. They are also going to look at the experience with the type of property you're buying. And the third thing they look at is experience in managing these types of properties. So items, the bullet point number 1 and the bullet point number 2 is if you don't have a strong enough balance sheet, or you've never bought an apartment building or a manufactured housing community, et cetera, before, and so you don't have any experience in it, the lenders are going to be likely to be asking you to find a sponsor for the deal, right? The third bullet, experience in managing these type of properties, can frequently have a property management company step in and be responsible for that item. But the first 2 bullets are going to be important, and they're going to probably pay more attention to your financial strength, particularly now as interest rates are going up, right? But they also have paid over since the 2007, 2008 debacle. They've been paying more attention to your experience with buying that kind of property. So if you have not bought any, 4, 5, 6 units, but you have some single family properties, that may well work for some of the experience issue. So if you're lacking in any of these areas, the bank is likely to ask you to find a sponsor. It helps going in when you are looking to buy this to understand that you may need a sponsor for a loan. So one of the things we've talked about in previous Teaching Tuesdays is that you may want to consider starting with a smaller property, like a 3 to 10 to 15 unit, because if the numbers are smaller, the likelihood of you needing a sponsor is smaller. And it gets you the experience you need. It gets you some experience in managing. So smaller properties, and I would say, 5 units and under, 6, 7 units and under, may well not need a sponsor. But once you start getting into those loans where you are asking for $1 million, $2 million in loan, your likelihood of needing a sponsor jumps way up. And what they're basically doing, we talked about this, is that they're co-signing for your loan. That's basically what they're doing. For people willing to do that, they are going to want one of 2 things. They're likely to want to be an equity partner, to have some part of the deal for them to co-sign for your loan, basically. And that's what they're doing. And the second thing is that because you don't have the strength in your balance sheet, or you don't have the experience in this type of property, they're likely to want to be actively involved in a deal so they don't lose. I don't know what I wrote there. That's obviously a typo. So they don't lose their investment. I don't know why I put month there. I must have been having an Alzheimer's moment. So know that if you are buying this type of property, likely to be asking for or asking you about and be willing to answer those questions. Okay. There are a number of, whoops, I'm sorry, folks. There are a number of places that may act as a sponsor for a deal. So there are people who are associated with some of the larger people who teach real estate investing, who have family offices, who have other things, who are in the business of trying to find good deals to invest in. And in return for you finding the deal and getting it under contract, they will sponsor the deal and take some equity. So an equity partner can be somebody who's going to bring in some of the funds and a lot of them do, or they may just be putting up their balance sheet and guaranteeing the loan. Hedge funds sometimes do this, and certain types of short-term lenders do these too. There are a few, I won't call them hard money lenders, but they're kind of in the middle of private lenders and hard money lenders who work in this space and who are going to act as sponsors for deals. They have the experience in knowing how to look at these deals and to help in managing them. I think it's easier in a lot of times if you are working in this to see if you can find a partner who either has the experience in these kind of properties and or has the balance sheet who's willing to help you out with this. Just understand that they are going to likely want a larger than average piece of equity because they are co-signing for the deal, they're bringing their experience, and so they are at risk, and they are probably more at risk the more inexperienced the investor is. All right. Sometimes they may also have the experience and ownership with the type of properties you're buying. A lot of people in this, or some people in this, can play the role of both having experience with this type of property and having the balance sheet. Property management companies can be and are frequently used in managing the requirement for knowing how to manage these properties. And what you are going to want to do with those before you submit your bank package is have a property management company on board who's going to manage this for you, that has the kind of experience that the lender is looking for in these kind of properties, right? Okay. Do we use them or not? So this is just a basic pro and con. It's a good way to get a deal done. They get some of your equity, so you really have to do a little extra work a lot of times to make sure the deal works not only for you, so you get some ownership and some cash flow, but it works for your investors and it works for the sponsor. They bring experience and you can learn from them. And so they frequently have several properties and can help you figure out how to manage both the property manager and the property as you are gaining experience. They're going to help you avoid mistakes. And a lot of times it's easier, frankly, to get other investors if you're trying to raise a bunch of money, if they know you have an experienced sponsor and you put that sponsor in your in the documents you're going to give them, which is frequently initially it's like a 3 or 4 page kind of synopsis of who you are and what you do and who's part of the team. Okay. The other side is that they do take part of your equity. And so the deal becomes a bit skinnier. You get less cash flow and less equity, right? Also, that a lot of times they are going to want to have significant say in how that deal is managed, how that unfolds. And I have to say, if I was sponsoring a deal, I would want to make sure that I was involved in the decision making and in looking at how the property was managed, because it's basically my money that's on the line, right? So one of the things we do to avoid that is if you have 2 or 3 smaller types of property that you've started out with, then a lot of times the lender will use that to meet some of their criteria. And that really is one of the reasons I suggest you think strongly about starting with 2 or 3 small deals that are, 4 to 10 unit kinds of things. And after you get a couple of those under your belt, you probably won't need to have a sponsor. Now, the kicker is that what lenders consider an apartment, they don't consider the same as a mobile home park. They don't consider it the same as a self-storage unit. So when you get started, think about your first 2 or 3 deals being in one kind of sector: apartment buildings, manufactured housing, self-storage, whatever it is that's important to you, so that you can build credibility and experience in that. So I think that that's kind of the basic thing that I wanted to talk about with this. The last thing I want to do, before we start taking questions here, is that if you want to know more about multifamily investing, please go to this bit.ly/passive wealth webinar. It's free, and you can get a sense more of what goes into this. You can also look at our YouTube channel, which is listed there, that we post these Teaching Tuesdays, we post some shorts. And so if you miss some of this or want to go back and see things we've talked about in the past, please look us up on YouTube. We do weekly calls at 6:30, and then that's followed at 7:30 by our partners in the residential field. And so at this point, I would like to just turn it over to people who may have questions. Just open your mics and please ask questions, and I'm going to let James try and manage that.
Actually, we had one question already in terms of what kind of a cut or a spread is the sponsor looking for. I know it depends, but is there a range?
I haven't really been into that data in the last couple of years since COVID. It has been in the past 15 to 25 to 30%, something like that. But it's the numbers that are going to dictate that. So the more debt they have to sign for, probably the more they're going to want. But I don't know that there is any specific number. It's typically a range. And I think that kind of runs 10 to 30, 35%, something like that, more likely 15. But like I said, I am not up to date with that over the last couple of years. So I'm not sure what's been happening since then, to be honest. I'm funding my own deals these days. All right, anything else?
Not in the chat. Anybody want to come off mute? You got questions about sponsors or pretty much anything else? It doesn't have to be about sponsors. Any multifamily questions we can answer for you.
Where would you find the sponsors? Where's good places to find sponsors?
Some of that is your network, and I think that's probably the best way to go, is to start. We've talked a lot of times about one of the things you have to start doing now is to begin to build your network, to begin to find other investors, to find people who are interested in this space, and to begin to build relationships with them. A lot of people who are high net worth, they're going to fall into 2 general camps. The ones who are just wanting to be passive and want to be kind of a limited partner, so to speak, and those who might be willing to take a little more active role for a little bit of a bigger pot. The other thing is that you can negotiate with a potential sponsor to not have to put money in if they will sponsor your deal, if they will come in as a sponsor on the deal. So they're basically putting their balance sheet up and experience up for some free equity. The other place is to start building on LinkedIn. You can find kind of a sub-community of family offices and high net worth people. There are going to be people who are actually putting out that they do this sort of stuff. And you just have to look around and find people and begin to talk to them about what they're doing. So it's also hedge funds will frequently do this. You're going to have to look a little bit and build that, but there's a good reason to start doing that now. Does that answer your question, Sharon?
Perfectly, thank you.
You betcha. Other questions?
What kind of bank rate should you look for commercial property?
Right now, interest rates are still going up. So people who have a track record are likely to be able to find rates at, I'm guessing 5 to 6 to 6.5. And people who it's kind of their first deal, you're probably looking at 6, 6.5. So part of it depends on the nature of the deal and your experience, your balance sheet, who your team is, as to the interest rate you're going to be getting. But it has definitely gone up. And the other thing that's gone, that you're seeing along with it, instead of having a 5 to 10 year balloon, you're seeing 3 to 5 years if you are buying a property at a very low cap rate. But I've seen that changing recently. The cap rates seem to be going up because people can't sell at the prices they were able to. And with the interest rates up, banks are getting tougher and tougher in what they will lend on. And brokers know that. That answer your question, Brian?
Yes. I'm working with a client that he actually bought the property. Well, and he wants to refinance it and expand the commercial use. So that's what I was trying to dig out.
Okay, so he's wanting to refinance and take some of the money and reinvest it in the property?
Yes.
Yeah, that may be, it depends on what the income and expenses look like, what the profit and loss statements look like on the property. But it may, and it depends on how long he's held it. So the higher the LTV on it, the more likely you are to be able to do that. But the other thing to explore would be a line of credit, or if it is primarily a build out, a construction type of thing, to look at getting a construction loan on the existing loan that gets paid back after a certain amount of time. Because interest rates are going up and prices are coming down, that a lot of times where people bought these properties is not going to be what they think they're valued at now, unless they've held them for a number of years. And so it actually may be tougher to do that. And so actually refining before the balloon date is getting tougher, but you may be able to get a line of credit or find another investor to come in with with some dollar amount, and the owner give up some equity for those dollars being invested to do what they're wanting. So I would look at maybe more creative ways than to go to a more traditional lender for the next year or so. Did that did that do a better job of getting what you were getting at?
Somewhat. I mean, he has over 50% equity in this property, valued
Okay.
at about $700,000-800,000, and he just wants to borrow probably half of that equity to expand.
Okay, well, I would go in that if he is at 50% LTV,
Yeah.
then I would go in with a bit of a business plan of what I was going to do with that money. And I wouldn't ask for that money in a give me the dollars. I would ask for that money to put in an account that can be used for something that the bank can help oversee. So, because they're really concerned about right now that their loans are going to be working and that they're being used for what they're being used for. So I'm sure this is going to surprise everybody, but there are people out there who are going to say they want to use money. And I'm not saying this is your guy, but they're going to say they want to use the money to do A, B, and C, and they just take the money and do something else with it. So banks are starting to do things that are going to try and protect their where they are and their loans. I'm coming back for the third time. Did that get it, Brian?
It gave me some ideas about that possibility of using that line of credit with that oversight of the bank. That may be more attractive to the lender as well as the client.
Yeah, I mean, if that's what he really wants to use it for, then I've actually used banks frequently in the past to help me because I live at quite a distance from a lot of my properties, and I will get a construction loan or a line of credit and use the bank to actually go out. They always have most of them, the larger ones, have a person who goes out to make sure that the work has been done and that things are going the way it is. And then you can use that person to authorize the next draw once certain things have been done. But that puts you in a position, or your client in a position of making sure they have a really good business plan and scope of work that has specifics what needs to be done before the next draw is provided. That's going to be your responsibility. But banks are good about that. I've used them more than once to try and help me when I'm at a distance to make sure that things are happening as they're supposed to. And contractors can't really talk to mean old banks that, well, this happened and that happened. Banks are kind of cut and dried, black and white. It is or it isn't. Other questions?
I was just going to say Terry Painter started the apartment loan store, which has done a couple $1 billion worth of multifamily loans. I put their link up there. I haven't used them, so I can't, recommend them, if you will. But they're a great resource. And if anything, you can at least get a little bit of an education on what's out there. They deal with a lot of banks, and I don't think credit unions, banks, smaller banks, regional banks, and then obviously the agencies as well. So it might just be a good source of information for you.
All right, anybody else? I'm going to stop sharing. I think what I keep doing is causing everybody to, I'm trying to see if there's other people out there. What are you seeing on your screen, James? Are you still seeing the slide?
I'm seeing the slide, and then on the right-hand side, I see all the blocks of people's pictures or names.
Okay. Yeah, I'm going to go ahead and stop sharing.
Okay.
Do you want to put something up, or I guess I can leave this and I'll quit flipping around?
Why don't you put it on
Are there
the first
other
slide,
questions?
on the logo, if you want, on the first slide? There you go.
All right. Do other people have questions? If not, then we'll just kind of sign off, and you can come back in if you're interested in the residential family at 7:30. Next week, I don't have up, well, since I'm showing this, what's on target for next week, James?
I don't know. Give me a minute. I'll look it up.
Okay, I'm sorry.
It's all right.
Ask a question, Nicole.
Hi, Ann. What can I answer for you?
Hi, thank you for taking my questions here. So you see the price for the multifamily complexes, I guess the price is going down. Do you see that also on the residential side as well?
Yeah, I do. The residential side has more variation in it depending on the market, but a lot of the markets you're seeing price cuts, and you are seeing days on the market go up. All of which, both of those seem to be related to the market shifting into a buyer's market. I think as we progress through the spring into early summer, you're going to see it even more, that prices come down. And JP Morgan and a couple of the other big banks, they always do projections, quarterly projections in their reports on what's going on, what they think is going to go on with delinquents and purchases. And JP Morgan has increased, and so has, I don't know the exact amount, and so has Goldman Sachs, but they have both increased their predictions of delinquencies in double digits.
Oh my.
Which means they think there's going to be, more people that are 30, 60, 90 days late, more foreclosures, those kinds of things in the single family market. So I think, in the next 2 to 3 months, prices are going to continue to sort of settle out where they're going to be. I don't think they're going to come back to where they were, 5, 6 years ago, but I definitely think there's some downward pressure. And I wouldn't tell you I have a crystal ball to tell you where it's going to end up. I see that in a lot of ways. And here I'm going to ask Jane and Sharon, who are in Florida, in one of the hottest markets, what are they seeing in the residential market in terms of prices?
Prices have been coming down and days on market is a little longer, but they're still not coming down to reasonable amounts, especially in the hotter areas, like on the coasts in Florida. In the middle of the states, you can get better prices for houses, but still pretty high. But they are slowly coming down.
Yeah, and I think, do you think you two are do more in the residential market these days than I am? Do you think this is going to keep up for a year, for the next several months to a year? What are your predictions? I don't have a crystal ball, but I think you may.
No crystal ball here either. But I think just because housing in Sarasota, like where we are in Tampa, there's such a need for housing. I think it's still going to continue. There's still a lot of people that are coming from up north or have the 2 houses. So I still think on the Gulf Coast. And then, of course, the hurricane has added to that where, people got displaced. So they still need a place to live in the immediate area. So we're not really seeing a big drop. I think that it'll continue on our coast at least for another 6 months to 8 months. Just different.
And they're still clearing property out, putting new builds on in different areas up, especially in Sarasota where we are at. We're seeing a lot of new builds happening. But then we also talk to people who have gotten houses and bought them too high. And, the rents are just, they're pricing themselves out with the rental market, and they're stuck in a situation now and need to be bailed out. And I think, Jane, you had a question about the commercial side, right?
Yeah, just like we're familiar with the foreclosure process for single family. How long is that for multifamily? And do you see a lot of that? And because I know a lot of people during COVID were just going crazy with multifamily and paying way over price. How long does a foreclosure take? And is that where you can get some good deals?
In the commercial market, it's a bit different. That's a really good question. you see foreclosures, but it is much more likely that banks are actually going to contact or are going to look open to selling the note, or
Oh,
to basically finding the short sale picture in commercial is a little bit different, in that banks will look at people who they have loans with or who have good track records, and they will approach them. Now they have to approach the seller too. So in the residential market, the seller has to initiate and has to indicate that they are in a distressed situation and put the paperwork forward. In the commercial market, the banks already know this in both residential and commercial, but in the commercial market, the banks are more willing to step into that position and talk to both the owner and somebody who might be willing to step into that, and they negotiate with the owner and the potential buyer and themselves about where that might be. Now, I would bet you that a lot of banks won't admit they do that, but since I have done that more than once with a bank, I know they do that. So it's a real sticky position, trying to talk to the seller and a potential somebody else, but it works a little bit differently. You don't see so many foreclosures, and those that you do see, they're going to put a management company in place. And frequently the management company is going to spend everything that is brought in on paying themselves and paying employees and stuff. So you end up with a very skewed view of what the net operating income actually is on a foreclosed property. And that's worked to my benefit more than once. You know, I've gotten pretty good deals because there's, quote, no cash flow because the management company's been spending it all.
Okay, good to know.
All right, other questions?
Yeah, Nicole, I have a question for you. This is
Hi,
more,
Michael.
Mate, scans are great again. You know what? I'm not going to say again because they never were, and they're complicated. See, with Monza.com, making a Gantt chart is as simple as throwing a process of projects that.
Okay, I'm hearing, is there something in the background or was
yeah,
that
I'm
you,
sorry. I
Michael?
think that was my computer. when
Okay,
I clicked on it. I just have a question about your buying strategy. You mentioned a minute ago that some of the properties you own are like not that close to you. What is your range? Just trying to get what is your personal range as far as you buying, as far as distance is concerned? Just so I can just have that.
well,
as a nugget.
I'm outside of Washington, DC. And I have properties in Seattle and Portland and Boise and Las Vegas. And I have stuff in Montevideo, Uruguay, and Panama. So it's an issue of managing managers. So and because I worked for the federal government, I was one of those terrible employees that is a boil on the ass of you know who. I mean, according to a lot of people, we are totally worthless. I basically had to learn how to manage managers because I had a 9-to-5 job, or more likely a 9-to-9 job. And so I was really having to come up with ways to manage at a distance. And so that was my modus operandi from the beginning. I'm sorry for that aside comment there. I just listened to a blog not too long ago where every federal employee was a worthless piece of you know what. And it sort of bothered me.
You know what they say about opinions, don't you?
Yeah, I know. I shouldn't listen to him. All right. Did that answer your question?
Yeah. So when you were working your 9-to-9, did you travel to these places and for business or maybe vacation, and you just saw it and said, oh, I think that would be a good property to purchase? Is that how you came across these properties in these far-flung
Well,
places?
some of it, but I got transferred out here to Washington DC with my job, but I was originally from Idaho and Washington State. So I had a lot of people I knew in the Seattle area and Idaho and Portland, in the Oregon area. And so I used some of those people I already knew to help, but I also got to know some of the lenders out there and some of the property managers who managed in more than one state. And so a lot of people actually helped me find deals. Once you close a deal with one broker, they send you deal after deal after deal because they know you've closed on something. And so it's a lot easier to find something after you've closed. And they'll actually go looking for things for you if they think they're going to get both sides of the commission. So I didn't have too much problem with that. I was also buying, in the 2009, 10, 11 after the debacles. And so there was a lot of lenders that were really wanting to get rid of properties. And so it certainly wasn't as tough as it is right now to find good properties.
Thank you, Nichole. That was great.
Yeah, thank you. All right, if there are no more questions, I'm going to stay here because I want to hear what Sharon and Jane have to say. They're going to be talking about how do you evaluate a potential residential deal in 5 minutes. And I could stand to have my knowledge updated in that realm since I haven't been buying a lot of residential real estate recently. So I'm just going to stick on. So if anybody wants to talk about anything, that's great. And otherwise, I really appreciate your time. And what are we talking about next week, James?
That's so funny. I literally just had it up. Hold on. It is what should go into a letter of intent.
Okay, so as a 30-second, in commercial, we don't typically put in a contract to begin with. We put in what's called a letter of intent. It can be a letter, it can be an email, but it sort of lays out what we offer and the terms, and it's a beginning part of a negotiation. So we're going to talk about letters of intent and how that typically goes back and forth until you have come to an agreement on a deal. So I hope to see some of you next week when we talk about that. And I'm just going to stick around. So if you guys are welcome to open the mics and talk to each other, or talk to me, or talk to James, or ask questions of Sharon and Jane. Just whatever you would like to do. If you need to go, thank you very, very much for coming. And we'll talk to you next week, I hope.
If for some reason you leave the meeting and decide later you want to come back on, it's the exact same Zoom link. So you don't need a new one or anything.
So, Nichole,
Yes, hi, Ann.
so you don't live in Baltimore anymore? I mean,
I've never lived in Baltimore. I actually live in Montgomery County. So if you were to kind of draw a triangle between Washington, Baltimore, and me, I'm northwest of Washington and southwest of Baltimore. So I'm about halfway between. I'm just to the west of both.
oh, okay. Okay, because I saw you at the meeting before. So
Yeah, I've worked with the Baltimore RIA and the Real Deal Meetup and several others. So for whatever reason, I got to know the people up in Baltimore and that investment community before I got to know the people down in Washington. So I've just always hung out with them.
I see.
Where are you, Yan?
I'm still in Catonsville.
Catonsville, okay.
Yeah, yeah. So I have a question regarding property management.
Uh-huh.
topics. So David Landar, he suggested us we go to a link. It's called no. Oh God, what's the heck is it called? Whatever.
CIM.
Yeah. What's that? CISSM, something like that?
CCIM.
CIM.
CIM, yeah, that's right. So I found this woman. She was the horrible manager.
Yeah.
And, yeah, but she had like, you know how like when in a signature block, there's like, she got so many acronyms, you know, like
Yeah.
whatever certified, you know, like A to Z, you know, whatever, you know, it's just a ton of stuff. But she was the most horrible manager I have ever encountered.
Well, here's my $3 worth of take on that. The CCIM is a really well-recognized and well-respected certification for selling commercial real estate. Most of them have no experience with managing real estate. Now, they're in a lot of states, including Maryland, you need to be theoretically a realtor or have those before you can manage properties. A lot of states have set it up so that you have to be a realtor before you can manage. That doesn't mean you know how to manage. And my experience is that most don't know how to manage. So my go-to is always, I have actually an interview sheet that I use for interviewing potential property managers. And James, I wonder, is there a way for us to, we have a shortened one that, you know, is that we've given to people in the past. Is there
Yep.
a way we can get that to anybody who's been on this call, that we have their emails, that we could send it to them?
Yes, I'll figure it out because we did it last time.
All right, so that has some questions on it, and it really focuses on experience, what they've done in the past and how they interact with you. So Dave Lindahl is one of my mentors, and I adore the heck out of him. I've learned a lot from him, and he is really good at acquisitions and raising money. And I would say that he is not so good at managing and teaching people how to manage managers. So that's just my take. He's taught me a lot. I have a lot of respect for the guy, but knowing how to manage properties and manage managers is a skill unto itself. So I always focus, and I tell other people to focus on experience, to ask them what other properties they manage, and to go do some driving around, looking at those properties, do some secret shopper, ask some questions, get a sense of what's actually happening. Because what you're describing is something I have heard, I can't tell you how many times, and I'm really sorry that happened. What I will also say is it's hard to find a good manager. And so if you have expectations and in 60 or 90 days, the needle isn't moving the way you want it to, get rid of them and find somebody else. Over 25 years, I've come to believe wholeheartedly that if they can turn it around, they're going to turn it around. If they can't, move on. So none of this kind of letting people, well, let's give them another 30 days. Let's see how this works. They said they're going to do this. You know, it is, to me, it pretty much boils down to what Yoda said. I put it in my own words, is that there is reasons and excuses, and there is results. And I want results. I don't want to hear reasons. I don't want to hear excuses. I want results. But as Yoda would say, there is no try, there is do, and there is do not.
Mhm.
So did that answer your question? I'm sure it
Um,
wasn't what you were looking to hear, but that's my take.
So the initial contract that you signed with a property management company is 6 months? at a time?
No, I always have, it's a year contract, but I always have a clause in there that either of us can get out within 30 days notice.
Oh, okay.
Yeah,
Yes.
I'm not gonna put myself in a position with a new property manager where I'm stuck with him for 6 months.
Oh. That's a good one. Thank you.
Hey, Jan, if you're in Catonsville, one of our students just bought a property and got a really, really good deal in Catonsville. And then there's somebody else that came to speak at our meetup that's got about 100 units. And almost all of them he's been able to buy in Catonsville. So sometimes you can find stuff right in your own backyard.
I think I'm more focused in landlord-friendly states.
Yeah, I hear you.
Maryland is not, so.
Nope. Nope, I hear you.
Yeah.
Yeah, Maryland is not a great state, particularly if you are, I tell everybody all the time, I have states and 11 properties in 11 states. I have properties in 11 states. And Maryland is my 11th favorite state. It's just really difficult any way you look at it. The state is, to me at least, is not very business friendly.
Yeah. That's why I don't want to deal with them.
Yeah, but Virginia's pretty good. Delaware isn't bad. West Virginia's pretty good. Pennsylvania's better.
I see. Yeah.
A lot of people start buying in their neighborhood, and that's really reasonable to do that because it's, you know, it's, you can go see it, you can learn stuff. And there's nothing wrong with that. I know several people who do a very good job of managing in Maryland. It's just not, I'm not as good as a lot of people at managing in Maryland. I just, you know, kind of say it like that.
Yeah, we're trying to sell a house, our house, and looks like we're gonna have to hold on to it for another few more years because I don't want to lose money. So
Okay.
living in right now. So
Yeah, well, some people kind of, you know, that happens not infrequently. There's always cycles for every real estate market. Goes up, it goes down,
yeah,
stays flat, goes up, goes down, stays flat.
yeah. Sounds like right now is we're in market cycle buyers one phase.
I think we are in probably cycle 2 where we have gone over the top and are starting to come down. So so we are in the beginnings of a
buyers market.
Yeah, of a seller's market, of a buyer's market.
Yeah.
And I think it's going to get better over time. All right, we need to probably move on, and I'm going to turn this over at this point to Sharon and Jane, and let them take over. And and as more people come in, we will. It's going to be for the residential part of this and evaluating a deal in 5 minutes. And thank you, everybody who's still on. I really appreciate it. I hope to see you next week.